Hello and welcome to the What Drives Forex Markets, the Fundamentals Aspect video. Let's take a look at the learning outcomes of this presentation. We will be looking at who are the key speakers, European Union, United States of America and the UK. What is economic data and important announcements? Why this data moves markets and how markets interact. How you can make money from new news, repercussions on markets. The foreign exchange markets are indeed the most liquid and highly traded markets in the world. It is estimated that in excess of $4 trillion worth of US dollars are traded every single day in the FX markets. And that alone makes it an important market to be trading, as there is ample room for any size of execution. Currencies are traded in pairs, which allows greater flexibility when traders are searching for the best value. The first currency of the pair is the base currency, or the strongest currency when the pair was created. The second currency is called the quote currency. For example, buying the US dollar against the Japanese yen currency pair means that you are buying the dollar and selling the yen at the same time, while only one transaction is really taking place. Some of the most known currencies, such as the dollar, the euro, the yen, and Swiss franc, are shown as quoted currencies. Currency symbols have three letters: USD for US dollar, JPY for Japanese yen, or GBP for the British sterling, etc., where you can see that the third letter denotes that country's specific currency. USD, where D stands for dollar, Japanese and Y for yen, and so on. You should also know that the most popular and heavily traded currencies are the ones we call majors and include the American dollar, the euro, the Japanese yen, the British pound, the Swiss franc, the Canadian dollar, the Australian dollar, and the New Zealand dollar, while traders often use a nickname for those in their jargon. For instance, you could find that the Swiss franc is often referred to as the Swissy, the US dollar as a buck, or the Australian dollar as Aussie. Don't let terminology hold you back from understanding this amazing market. We should at this point mention that the reason the US dollar dominates the FX markets is because of its economy being the largest, while it is considered to be the world's reserve currency. In addition, the US dollar serves as the currency for other transactions, such as buying oil. Oil is priced in US dollars, and if a country wanted to buy oil, it would first need to convert its own national currency into American dollars or use up their dollar reserves. A stable political US system also keeps the dollar in the forefront. FX markets trade like every other market. There is a technical side which deals with support, resistance, and also indicators and oscillators. The fundamental side, though, deals with all new news, data, and information released to the market by policymakers. Let's now examine the fundamental aspect of trading FX. Fundamental data concentrates on what is happening outside of the charts. The common view is that 80% of the time the markets are trading technically, and 20% of the time the markets are trading due to new information, so 20% fundamentally. The fundamental side of trading falls into three main categories: economic data, key speakers and policymakers, global events. These also fall into the systematic type of risk events, as markets would heavily react to those, being an event that no one expects: terror attacks, natural disasters, and so forth. Traders should be equipped with the necessary skills of diversifying their risk among their positions and also apply the so-called hedging strategies, that is, protection. Although fundamentals only account for 20% of trading activity, these can produce some of the biggest moves and therefore potential profitable trades. All countries are responsible for releasing their own economic data. This data will come from government agencies. The non-farm payroll, for example, is released by the Bureau of Labor Statistics. This is meant to keep the figures independent and out of the private domain. These figures are important when trading FX, as they signify how well a country's economy is performing. A good USA gross domestic product, the GDP figure, could mean that you would buy the dollar over the euro if data from the European Union was not as favorable. If you multiply the number of data releases and the number of currency pairs you can trade, it is soon apparent that there are many ways to make money from fundamental data events. Expectation is key when trading fundamental data. There will be estimations or analysts' recommendations of what to expect on a certain set of announcements, but markets do tend to surprise us, missing a figure estimation even by the slightest, and you will find that the corresponding currency pair will have moved in just a matter of few seconds, quite a few pips. When trading fundamental data, you might opt to avoid trading around these first minutes, to avoid the noise, as we call it, excessive short-term volatility, which often would not make much sense given the actual figures. Important announcements, aside from those by key speakers, would include figures around the PPI, the Producer Price Index, the jobless claims, a figure related to level of unemployment, or the PMI, a Purchasing Managers Index. You can see at the table provided all the crucial information related to that, the time of release to your left, the country where the figure will relate to, as well as the consensus and current figures for that specific announcement. So that at a glimpse, you know what the market is expecting and which times of the day might not be suitable to your risk profile. Note that not all data is equal. The world economy is moving in cycles. Indeed, everything in the world has a cycle. In economic terms and in the FX markets, traders are looking towards the effects of growth and inflation. In this respect, not all fundamental data is equal. Traders will focus more on growth figures when inflation is under control and on target, but focus on inflation when growth is stable, but more importantly, when we focus on potential changes in interest rates. When selecting fundamental data to trade, you have to identify what traders will be both trading, but also what their expectations are. Data from different countries will also affect the markets differently. Take the recent growth slowdown from China and the effect on their stock markets and the global markets, for example. Also, it is important to pick and choose the data events you trade. Not every figure is there to be traded. It would be prudent to think of the markets on what we call a top-down approach. You first take a look at the bigger picture, that is, inflation and interest rates, and how this will boil down to specific countries. Then you choose your currency to trade, as you will know which countries an inflation or interest rate change will refer to. You can then see which fundamental news will most likely affect them, but you already have the big picture. Choose your opportunities and always bear in mind that markets and currency pairs are interrelated. A move in the Japanese yen might well affect the US dollar or the euro. The diverse phases in an economy, the different cycles, that is to say, are also playing an important underlying role here. Once you have identified which economic cycle we're in, which will be whether traders are focusing on growth or inflation, then you can pick the figures you may wish to trade. For the FX markets, the USA's non-farm payroll, GDP, and retail sales will be very important globally. These are all growth figures. For the rest of the FX markets, the Federal Open Market Committee, the Bank of England, and European Central Bank's interest rate decisions will also play a big part in how traders put value on specific currency pairs. These are all related to inflation. So it goes back to what we were referring to above, that seeing the bigger picture is always beneficial, as it will be key to help you understand how the economies are intertwined, move in cycles, and affect one another. So to determine what cycle we are in, simply watch for the daily range around these data events. The bigger the daily range, the more interest and therefore opportunity there is to trade the two sets of figures. Take growth, for example, one of the two key factors or market movements. Growth focuses on anything to do with money being brought into the country or being spent. Also, the ability of more money being spent domestically. Inflation, on the other hand, focuses on the rate in which money, assets and cost increase over a defined period of time. You will also be able to see from the market chatter, news wires and talk on social media as to what people, and therefore traders, will be looking at. In trading terms, the USA still leads the way for main data releases for reasons explained at the beginning. You will find that the majority of FX markets will move over all major growth or inflation data from the USA. UK data is much more localized, for example, and will affect the FTSE and therefore FX pairs like the cable, that is to say the sterling against the US dollar, than it would affect the euro dollar. Likewise, EU data will have a much greater effect on DAX index and CAC and will therefore move currencies like the euro dollar rather than the dollar yen. USA and more recently China data, however, will affect most markets. This means that serious changes in either growth or inflation expectations will move most of the global foreign exchange pairs. Here is an example of the US non-farm payroll and its effect on the euro dollar. The non-farm payroll, the NFP as we call it, was expected at 188,000. The actual number that came out was 151,000. This was below the market expectation. The new news was below expectations. These initially sent the euro up against the US dollar. As this is bad news for the USA, you would expect this is the opposite of what you may expect. People bought the euro over the dollar. However, as the news filtered through to the market, traders started to sell the euro, buying the dollar, and this continued to make new lows. This goes back to what we discussed as market noise, as in the very first minutes or seconds of a specific figure release, markets will not necessarily react rationally. You might want to avoid trading within this short period and close all your positions prior to the release and reopen after that. Remember, you can always trade any data from a technical perspective. In this case, look at the Fibonacci from the highs to the lows. 80% of the time, a strong directional move will retrace to the 50% Fibonacci level. Remember the rules of supply and demand when trading economic data. Good news should increase demand, and bad news should decrease demand of a currency. With the NFP, this bad news made people sell the euro and buy the dollar. This is counter to what the rules generally say. This means again that not all data events are a logical way of trading or making money. The reasons for this are complex and have to do with the fact that bad data in the current economic climate means that interest rates may not go up as quickly as people think. This again highlights how tricky it is to trade fundamental data. Only when you have a true understanding of the whole picture should you attempt to trade this way. If 1 euro buys $1.5, the new news will affect how much traders and the market will look to pay in the future. Now, we have said that this market, like others, is really dependent on key speakers, which are the policymakers. People who decide a country's fiscal policies. This is everything to do with interest rates, money supply, and how the finances are managed. Without a doubt, the most important person is Janet Yellen, head of the Fed, the Federal Reserve. The policies that run the most powerful nation on earth are very important in trading terms. Mario Draghi, head of the ECB, the European Central Bank, has a big part to play in the future or lack of future in Europe. Especially lately, with weak growth and a debate of whether the economies are ripe for an interest rate increase, speeches of these policymakers are always what traders focus on. This is what testifies that although the markets tend to be affected by a mere 20% due to fundamental moves, this 20% normally accounts for big swings. Here is an example on the 21st January 2016 when Mario Draghi indicated that there was the possibility of more QE, quantitative easing. Quantitative easing refers to a monetary policy that involves stimulating the economy by buying financial assets from financial institutions, hence raising their price. Markets get affected even by the slightest hint of change of policies, such as extended QE. This dramatical change of the demand for the euro against the dollar and the idea of printing more euros meant that traders sold the euro and bought the dollar, sending the euro-dollar pair sharply downwards. In such interesting times as the ones we're going through, where central banks are exhausting their means to tame inflation, or in this case, to avoid deflation, and irrelevant announcements that will pinpoint the degree of success or not are likely to cause major turbulences in the markets. Now, world events are also important, as you can imagine. When the Paris terror attacks happened in France, there was a shift in the demand for the euro and for the French stock market, the CAC 40. Although these moves were nothing compared to 9/11, there is still a strong correlation between what happened when these sort of global events happen. Native currency goes down, and also does the stock market. Safe haven like gold and government bonds may go up. As a means of conclusion, it is important to keep a balance when trading. A good way of looking at fundamental data is that it will still trade technical between support and resistance, but new news will speed up this trading action. Keep a balance and remember that fundamental moves can move faster and further than standard technical trading moves. Always look for how long the move took to happen, the size of the individual candles, and the overall size of the move. The quicker, larger the move, the more likely this is to be due to fundamental news.